Hello students, welcome to Chakani Institution YouTube channel. #Our pride is more educational. My name is Lutendo Chakani and I'm an accounting expert. Today, welcome to introduction of chapter 6, which is the first episode on this chapter. So I want us to go through the first episode where we briefly explain about chapter 6. What are the things that we expected on this chapter 6? Remember, I did chapter 5. Please continue watching those episodes on chapter 5 so that you can be able to understand. You must have a logic on accounting. So don't watch chapter 6 before you watch chapter 5. So before we get started, please make sure that you subscribe, like, share, and more important, turn the notification bell on so that all the time when we upload, you are the first one to get the notifications. So let's get started. Today, I want us to look at chapter 6. And this chapter 6, why I like it is that chapter 6 is about reviewing and adjustment. Are we all together? We are about to review and also we adjust, which is more important in accounting. Students, and what I have realized is that students in accounting, they are not failing because they don't know how to prepare the financial statements. They don't know how to prepare the ledger accounts, which you call them T accounts. They don't know journal entries. No, I think the problem that we have in accounting, more important, is the issue of the adjustments. Students are failing to adjust. That's why accounting tends to be hard for them. So today, I'm going to do chapter 6. And more important is that chapter 6 they are going to deal with the journal entries. That is the required that we are expecting. Number 2, they are going to say prepare the what? The financial statements. Number 3, they are going to say deal with the ledger accounts. Number 4, they might require you to deal with the notes to financial statements. So those are the requirements that we are used to in most chapters. But this is not our problem, students. The problem that we have is about the adjustments. And what I have realized about the adjustment is that if you are going to do chapter 6, you need to expect some of the adjustment. Remember, adjustment of accounting always repeat. They might just change how they give you the adjustment, but they always repeat. And I want us to talk about the first adjustment, about the expenses. It can be in accounting transactions, preparing the financial statement, journal entries, ledger accounts, and you have the adjustment. They don't give you adjustment about expenses. This might also help the high school learners. So when you have an adjustment in accounting about expenses, the first thing that comes in your mind is to know what is the purpose of being given this adjustment about the expense. Why? In most cases, when they give you expenses adjustment, they want you to identify whether we have an accrued expense or whether we have what? Prepaid expense. I'm sure you are following. So, meaning that wherever you read the adjustment and it's about the expenses, in mind, you need to think about whether I'm going to get an accrued, whether I'm going to get the prepaid expense. So, what matters after knowing that is that you need to know, how do I see that I have an accrued expense? How do I see that I'm going to have a prepaid expense? So let's start with an accrued. Accrued means what? The word accrued means outstanding. Means that something is what? Is outstanding. But here we are talking about an expense. What does business do to the expense? We pay them, right? Our expense must be paid. But if an expense that we need to pay is now an accrued expense, simple means that this expense is not yet paid. And all together. So these are the expenses that are not yet what? Paid in your 12 months. Each and every company operate for 12 months, and we must pay our expense fully 12 months. So if we don't pay some of the months in 12 months, they must be regarded as what? As an accrued expense. And more important, what is an accrued expense in terms of the elements? Accrued expense is liability. That's why I indicate with A. Let me get something to erase. That's why I have the what? L. Are we all together, right? Expenses, in our mind, we know that they want accrued or expense, or prepaid expense. How do we see that now this expense transaction is talking about the accrued? It's when the expense is not yet paid in our 12 months. There is any month between 12 months that is missing. We have been paid, not yet paid. So we regard it as a what? As an accrued. But let's come to identify the prepaid. Prepaid means prepaid. It's pre and it's paid, meaning that some is an expense that these are the expense paid in what? In advance. I think this one is clear. So these are the expense of the company that are paid in what? In advance. In advance we refer to what? Remember, we operate 12 months, meaning that you paid more than 12 months. You paid for 13 months, you paid for 15 months, you paid for 14 months. And our company must pay for what? We must pay for 12. So if it exceeds your reporting date, simply means that your company having a prepaid what? Expense. And what is a prepaid expense? Prepaid expense is in assets. So if I paid something in advance as a business, that person who have received my money is owing our business, because at any time we can claim our money and all together. So when you come across water, electricity, telephone, insurance, the issue of the rent, expense, just know that they want to play around here. So when we are doing the transaction on this chapter 5, bear in mind when we read the transaction, if it's about an expense, you need to be able to think, what is the situation now? Is it an accrued situation or a prepaid situation when it comes to these expenses? I'm sure you are following. This is just an introduction on chapter 6. And another adjustment that you are going to have, students, are going to have adjustments that are much more based on the what? On the incomes. On the incomes. So when it comes to the incomes, you know that the situation is about accrued. But this accrued is what? Is an income, an accrued income. And then you are going to have what we call income received in what? In advance. In advance. Income received in advance. There is another name to call this income received in advance. I want you to tell me on the comment section if you have done proper accounting in high school. So these are the situations that when you see the adjustment of incomes, it costs an accrued income, or it costs what? Income received in what? In advance. So meaning that when we read the transaction, when we are busy on the episode number 2 on chapter 6, look at which element is affected. If it's an income, you need to think about, is it an accrued situation or is it an income received in advance? So now we need to understand, how do we identify if our incomes are accrued? Are we all together? As I have indicated last time, that expenses are paid by the business, but incomes are what? Are received by us. So something that we are receiving, but it's what? It's an accrued. Remember, accrued, the word I said, is the same as outstanding. This simply means that these incomes are what? Are outstanding. So meaning that these income are what? Not yet received. Others, they call them still receivables. They are still receivable. And accrued income is our assets as a business, because we are still waiting, we are still expecting. And then we come to what we call income received in advance. Income received in advance. It's just a pre-income. In other ways, the opposite of the prepaid expense. So this income received in advance, they are incomes that we have received for next. We have received for the next what? Next financial year. In other words, mean that instead of receiving for 12 months, we receive for more than 12 months. So they must be regarded as a what? Income received in advance. And this income received in advance, we are owing that person who have given us this income, which means that it's an liability. I'm sure you're following. Once you get these things, each and every adjustment about expenses and incomes, when it causes the accrued, income received in advance, prepaid, you will be able to to understand. So this is the second transactions that we are going to come across in chapter 6. And then after that, if the adjustment are not much more about incomes and expense, what are we going to expect? Number 3, you must expect adjustment about assets. Are we all together? And we are going to expect this. We're going to expect the issue of your stock. You don't know what will be happening to your stock. Remember, the stock can be damaged. There must be damage of stock. There might be donation. There might be drawings. And all together. So it means that when we talk about in assets, they might come through the issue of the stock. And what happened to the stock? The stock can be damaged. The stock can be donated. The owner can take the stock, which caused the drawings, right? And then the other things on the assets, they will talk about these fixed assets. Fixed assets, which in varsity now we call them what? PPE. They will be talking about the PPE, what happened, the depreciation issue, the profit or loss on sales, the issue of the derecognition of the what? Of the PPE. So this is the issue of the, let me just indicate, it's about the depreciation, it's about profit or loss, it's about disposal. We are all together, right? So I'm trying to, if you see assets in the adjustment, they're talking about these things. And the other thing that they might talk about, it's about your debtors control. You remember? Debtors control in varsity, we are now referring at as a what? As a receivables. So these debtors, in terms of the adjustment about the assets, they will be causing the issue of the bad debts. So meaning that it's gonna be bad debts. They will be calling the issue of the bad debts recovered. So meaning that you have recovered your bad debts. And then the other thing they will be talking about sales, which means you sold goods to what? To the customers. So I'm sure you're following my explanation, so that when we go to the adjustment on chapter 6, analyzing the adjustment, identifying which accounts affected, which element is affected, double entry, which accounts is debited or credited, you need to understand that in terms of assets, these are the things that we need to check on. The issue of the investments, you know, the issue of the cash, such as bank, cash flow, those things we need to check about, the issue of the PT cash. So those are the things that we are going to come across around the assets in summary, right? There might be others that I have omitted here, but these are the most adjustment that we are going to come across in chapter 6. So I hope you are enjoying the lesson. Please, if you have any question, make sure that you ask in the comment section, or you just text us on WhatsApp. Our number are on screen there. So now, the other things that, number 4, They might affect equity, and equity is not much. They might be affected by the issue of the capital. It might be affected by the issue of the what? Of the retained earnings. So that is the equity. Equity mostly is affected by the capital or share capital. You can call it capital or share capital. Depends on the types of the business. So these are the adjustments that we are going to expect about that affect equity when the owner contributed more. And I forgot the issue of the drawings. It also affect the owner. The owner taking something from the business, the owner contributing to the business, and also the retained earnings. There are people who confuse the two. Students, capital is not a money. I want you to get it clear. Capital is not a what? It's not a money. Capital is anything that the owner contribute to the business to run. The owner can contribute a PC, the owner can contribute a vehicle, the owner can contribute money. So it's not a money. Let's forget the issue of the money when it comes to the capital. It's not a money, anything. And then drawings is not a money, students. Drawings is anything that the owner can take from the business. The owner can take a stock. The owner can take stationery. The owner can take PC of the business and make it as a personal use. The owner can withdraw money for personal use, meaning that is the what? A drawings. So this is the issue that we are going to come across when we go to episode 2, doing the adjustments or on the first activity based on chapter 6. And then lastly, I think the issue that we have, the last one, it's about number 5, which is liability. So these liabilities that we have is going to cause a lot of things. It's going to cost what we call buying from what? Payables. It's going to cost issue of a loan. So buying on credit, the payables, it's going to cost the issue of the bank overdraft. And altogether, it's going to take issue of the SARS income tax. SARS income tax. The loan is going to cause the issue of the what? Of the interest, which is the interest expense. That's what you need to understand when you are doing this chapter, dealing with the analysis of the adjustment, and then we record. So these are the things that we are going to discuss more in practicals. When we have an activity, we read the adjustment, we identify the accounts so that we can be able to answer the required. Because everyone, I believe that you know how to prepare the financial statements, you know how to prepare the journal entries, the ledger accounts, the notes, you understand? But the problem is on the how do you adjust which accounts affected, which elements is affected, and which one are we debiting, which one are we crediting. So these are the things that we have. So I hope that you are also going to be with me on episode 2 in our chapter 6. We have a lot to learn together. Please make sure that you subscribe, like, share with your fellow friends so that we keep on growing, so that everyone can be able to learn. I love you so much. I will see you on the next episode.